There are many, many interesting and positive things which make me comfortable about the medium-term trajectory. But at the same time, I don't want to be drawn into a sense of complacency that growth is a given. If the export growth comes in for goods and services, acceleration happens, and the domestic capital formation cycle accelerates, we can do an 8.5% as well. The US has not done that. So they are having 8% plus fiscal deficit with 3.7% unemployment. So as the economy slows in the absence of continuous expansion in fiscal deficit, I think the debt to GDP can go up even more. The medium-term outlook is very worrying. It has been found that countries that cross 40 before turning rich never turn rich.
The Sound of Money with Santosh Sirur.
Hello and welcome to another super special edition of the Sound of Money podcast with me, Santosh Sirur. Today, joining me from Mumbai is a very, very special guest. With me on this show is Mr. Neelkanth Mishra. Mr. Neelkanth Mishra is the Chief Economist, Axis Bank. He's the head of global research and a member of the board, Axis Capital. He's also a part-time chairman of UIDAI. And Mr. Mishra is also a part-time member of the Prime Minister's Advisory Council. And of course, he's also a member of the advisory board of the India Semiconductor Mission. And IIT Kanpur ranked 4th. Welcome to the show, Mr. Mishra.
Thank you, Santosh. Thank you for having me here.
Mr. Mishra, the first question I have for you is, it's so much of very much of positivity all going around in India. Is India heading in the right direction? Because on all fronts, it seems to be, very positive news. Very fact that the incumbent government is almost certain to be heading the next 5 years. I'm sure the strategy, the policies will more or less be similar on what has been in the last 10 years and much more aggressive probably. What is your view of India in the next 10 years?
Yeah, so I think it is a bit dangerous to be thinking about, growth trajectories that go very long forward, right? So I've seen, with much to my amusement and then despair, that an economist talking about 2072 targets for GDP. Remember that it is very hard to grow at the pace at which we are growing. It requires tremendous amount of effort in terms of looking forward to potential problems and then addressing them. So frankly, beyond 5 years, it is futile to project. There are many, many interesting and positive things which make me comfortable about the medium-term trajectory. But at the same time, I don't want to be drawn into a sense of complacency that growth is a given. Because remember that there is a lot to the business cycles in India, which is not in the government's direct control. So, for example, one of the reasons that the economy is doing very well right now is that the real estate cycle has turned. So, in any subcontinental sized economy, especially ones like India, where a lot of housing needs to be built, it is one of the largest sources of demand that you can think of. Between 2012 and 2020, we were going through a protracted downturn in real estate, which is why our growth rate had slowed down. Now that the real estate cycle has turned and it is driven primarily by markets, the economic trajectory is looking much better. But if we want to keep growing for the next 10 years and the 15 years and 20 years, there are many, many meaningful reforms that we need to continue to undertake.
Okay. But looking at the state of India geopolitically, with all the wars around the state of United States economy, or for that matter, Europe in general, India seems to be in a very sweet spot. And also a very strong leadership at the center, a very firm foreign policy. Mr. Mishra, what is it that you see, India's role, not just in economics, but even politically or on the international front? If you could, join the dots for us.
So the direction of causality is from strong economy to strong geopolitics. And it is very rarely is it the reverse. So geopolitics and, can be an enabling force. It cannot be a primary driver. So, for example, the first phase of growth in China after they joined the WTO was indeed driven by exports, and I think that integration was very helpful. But after that, it was a lot to do with development of robotics, development of internal infrastructure, very rapid growth, perhaps too rapid a growth in their real estate sector. So India too, given that we don't have the same political structure as China's, and I'm happy we don't have that. It is going to be a much more balanced growth. We have to look inside and make ourselves more competitive. Where geopolitics will be helpful is in technology transfers. Remember that of the three elements of growth, which is labor input, capital input, and total factor productivity, that is, how many more workers are you getting of what quality, how much capital can you inject of various types, debt, equity, and all that, and how are you getting the technical expertise, the technological expertise to use the labor and the capital much better. These are the three components of growth. Now, labor, of course, is totally intrinsic, but capital can be supplemented, right? So we can get 60, 70, 80, $100 billion every year of foreign capital, which can help growth, right? So if this capital comes in, its deployment itself could actually drive maybe 1.5% of growth. If you build in the expertise that it brings along, so integration to global value chain. So for example, if Apple iPhones are being assembled in India, there is a lot of expertise on how to assemble phones which are coming in. Over the next 5, 7, 10 years, you will have factory managers, workers, designers, who can then perhaps create Indian brands, which then of phones, which can then start getting exported. So that TFP is also something that foreign firms can bring. What diplomacy and geopolitics can enable is access to that capital, access to that technology. But a large part of growth, so this, as I said, we'll be adding maybe 1.5% to growth. But a large part of the growth, given how large we are, we are 17% of global population, has to be internal. How do we ease logistical constraints? How do we price energy efficiently? How do we manage cities so that they're not, every time there is a 5% growth, that the cities start choking up? Yeah. So how do we solve those problems? How do we create pools of risk capital, which can invest in, say, renewable energy sources, energy storage, on machinery, on robotics? How do we make sure that the debt capital that our financial system is providing can be provided at the right size to the right entrepreneurs, right? So for the longest time, the financial system, and like in the West, was only capable of providing the 100 crore loans, 1 billion rupee loans. How do we provide 1 million rupee loans? How do you provide 100,000 rupee loans at scale? Because that's the size of the entrepreneurs. Yeah. And so if we solve those problems well, then that is the primary driver of growth. I think geopolitics will be an enabler, the cream, but the cake has to be ours.
As you rightly said, right, and India very traditionally is very entrepreneurial, right? You have communities who are so much into entrepreneurship, and I believe the government providing the right kind of facilities or the infrastructure now that we see in the last 10 years probably puts the entrepreneurship spirit into a different orbit. Do you see that happening now? I mean, we do talk that off in the media, but on the ground, is there that you see are any challenges? Because where I am coming from probably is the recent, of course, there could be bad apples like the recent Paytm issues or the Byju's issues, but they are one-off kinds. Do you see those threats or challenges also could be impediments? Because end of the day, the global scene guys are going to see at these examples and be worried a bit about India, right?
No, but see, for each one of these examples that you mentioned, I mean, there are dozens, if not hundreds of firms which are actually benefiting, right? So let's break this apart into three parts. So the first part is that the very essence of government policy is to ease access to capital, to ease access to market. So, for example, when you think about something like ONDC, so when the reason the government is pushing ONDC, which is Open Network for Digital Commerce, for those of your listeners who don't know, it's like, having Flipkart or Amazon, which are supposed to be marketplaces, having a totally open marketplace where anyone can sell, anyone can buy, anyone can provide logistics and all that. So ONDC, the reason why the government is so eager for it to succeed is that it provides ready access to markets. The reason why the government has been very supportive of UPI is that it allows access to digital payments, because earlier you needed to get a POS device, which required a certain level of balance sheet, comfort, and all of that. Today, anyone can stick a QR code and start getting those payments. It's a huge your ability to get capital. So things like the account aggregator model, which is also called the Sahmati model. So I think from a regulatory perspective, the government is using technology as well as policies to break through what is a classic, economic chicken and egg problem, where if the firm is too small, no one can lend to it. And that is why the firm remains small, right? So how do you break out of that? You bring down the unit costs, and that is what the government has done. So that is the first step. Yeah. The second is that even if you do manage to, say, set up a QR code and using ONDC start selling, say, very good masala chai to everyone in the neighborhood, what if you get that surplus and then you want to package some farsan, or like the namkeen, some snacks to the whole state? Do you have the national highways where perishables can be transported? Do you have the access to packaging technology? And for that, you need heavy infrastructure. Do you have access to regular electricity? And so I think that's the second leg of this, that I think a lot of the government priority over the last 10 years, I would say even the last 20 years, has been in solving those basic problems. How do I make everyone connected through all-weather roads? How do I make everyone get access to 24 hours of electricity? For example, how do you get women to work if they don't have access to dense forms of energy? If they're spending all their time collecting firewood and using those stoves, how do you get them to work? You give them LPG, you give them piped water, you give them a toilet in the house. Now, there is a third aspect to it, which is that in order for some of these companies to compete in the global ecosystem, in the global marketplace, you need the aircraft carriers, in the sense that, for a whole flotilla of smaller ships, or let's say smaller suppliers, which can then feed on to larger companies. Because when you're out in the global markets, you need a certain scale to be able to build your brand, to be able to command a certain share of supply. And for that, you need large companies. And therefore, when the government started off with these schemes like the PLI schemes, the whole objective was to create these larger entities, support these larger entities, so that they go and compete in the external market, and in the process then draw up a lot of the support base, right? So when you see the support for electric vehicles, it's about not just making OEMs, it's also about creating that whole ecosystem behind them. So these are all several steps that are being taken to make sure that the operating environment is very growth positive for smaller firms.
Absolutely. Mr. Mishra, talking about GDP, right? It's always a headline news. It's about 6%, 7%. But is that the way India is growing? Do you see there's scope or immense potential, I would rather say, for a lot more beyond 7%? And if you do see that, then how do you, and from which pockets of the industry do you see the GDP growth?
Right. So again, it is helpful to break this down into the labor, capital, and TFP framework, right? So labor input, I think, will keep growing at about 1%, whether we like it or not. It's going to grow at 1%. If we can get more women into the workforce, if we can create enough jobs, then perhaps it'll be faster. But 1% is more or less a given. Total factor productivity, given the pace at which India's technological innovations are happening, and the fact that we are a huge provider of business services to the world. Now, when we provide business services to the world, the conventional benefit that everyone thinks of is that we get a lot of dollars, that there are jobs created. But I see over the medium term a much more significant impact of that, which is that there is technology transfer, there's transfer of expertise. So if 20% of all chip design engineers are in India, if an Indian chip design company was to start off, finding resources is the least of the problems, right? So then if you are, say, you have a global capability center which is managing procurement for a US-based retailer.
Yeah.
If tomorrow an Indian retailer wants global best standards or best practices in procurement, so all of this is happening. And I think total factor productivity growth can be 2% plus. So 1% labor, 2% total factor productivity growth, 3% growth.
Yeah.
What happens to capital formation? Now, capital formation in India has been cyclical, right? So sometimes it is 2.5, sometimes it can be 5 or 6. So if it is 5, then we grow at 8%. If it is 6, we grow at 9%. If we grow at 2.5, we grow at 6.5 or 5.5, right? So that is how this cycle plays out, right? So the business cycles, the economic cycles are played out by capital formation cycles. So at this stage, it does seem like, and some of these things are modeled, some of these things are discovered. It does seem like at a 4% kind of rate, our economy tends to be stable. So the trend growth for India should be close to 7%. Can it be 7.5? Possibly. I mean, as I said, it's a discovered rate, so we have to see where the economy is. Now, it is possible, and actually I would say it's to some extent inevitable, that when the business cycle turns, when the capital cycle turns, it tends to overshoot. So, which is what started to happen in the 2008 timeframe in India, and even in the 2010-11 timeframe, where the massive global stimulus, there's a lot of Indian stimulus, and then economy really accelerated, right?
Yeah.
So, if those things start playing out, if the export growth comes in for goods and services, acceleration happens, and the domestic capital formation cycle accelerates, we can do an 8.5% as well. But I think beyond that, it starts to become very tricky and then unsustainable, right? So when the last time we were growing at 9%, we were doing capital expenditure at an extraordinary pace, and I would say an unsustainable pace. So for example, we had a steel capacity of 45 million tons, but at one point there was 60 million tons under construction. In power generation, thermal power generation, we had capacity of some 120, 130 gigawatts, and there was about 200 gigawatts under construction. Now, of course, that meant that GDP growth was very strong while you were building those plants, but once those plants were built, you can guess what happened, right? So then you have a long period of digestion of the excess capacity. I think from a sustained perspective, I think 7% definitely is sustainable. I would say even perhaps 7.5. But beyond that, I think we need the global cycle to be conducive, and happens because of domestic factors. It won't sustain beyond a few years.
Yeah, you rightly mentioned global factors. So if I could have your view on the US and the China, both these economies, because whatever said and done, end of the day, they have an impact. And India indeed has that, right? The stock markets go up and down depending on what happens in Dow. Maybe if your views on where is US currently heading, and more so from the debt issue, and the second, China, because of the current situation there, the markets going down, the economy, whatever whether it's growing or not really growing, what's your view on China and the United States?
Yeah, so let's look at the US, right? So over the past year and a half, the economy is surprised on the upside. So you'll see that the US growth projections have been revised up. In fact, even right now, versus I think 1.6% growth, that is because consensus, it looks like it'll be upgraded to 1.9 or something, right? So US economy is definitely doing better than what had been feared. The question is why? And once you dig there, you become really scared, right? Because what the US has done is it has inverted its policy stance that it adopted after 2009. right? So 2008-9, when they got into trouble, they had recapitalized their financial systems with a lot of fiscal support. And so they said, look, we need to keep our debt to GDP intact. And therefore, we will do fiscal consolidation. We'll slowly bring down our fiscal deficit. But we will do monetary easing because the economy had scars. The real estate bubble had burst. A lot of the financial system had to deleverage. And therefore, they said we'll have very easy monetary policies. Now, what they found that was, and this is coming from my interactions with some of the policymakers who were there at that time, is that it didn't work out very well. Right? So what happened in the US was that it took 7.5% for unemployment to normalize, and GDP growth was anemic. Wealth inequality spiraled up because if you bring down cost of capital, every financial asset, every real asset, started becoming more expensive. So they reversed it. So now what they're doing is tight monetary, so that we are observing, and very loose fiscal policies. And so their debt to GDP is an absolutely unsustainable path. And the day the market really starts to worry about it, I think it will cause significant amount of churn globally. One of the reasons that despite, so just to give you perspective, FY22 to FY23, the US fiscal deficit went up from $1 trillion, adjusted for the educational loan waivers, which are one-off, to $2 trillion. So you have a dramatic increase in fiscal deficit. And when you do something like that, how can there be a recession? In fact, in the first 4 months of this year, their fiscal deficits have again gone up. Right? So it's not that they're slowing down. So if the fiscal deficit keeps expanding, how can the economy go into recession? But the moment they stop, it goes into recession. The challenge is that this is a pro-cyclical fiscal deficit. So as you know, economic policy, the theory suggests that you should have a high fiscal deficit when the economy is weak. But when the economy is strengthening, then you should draw down, which is exactly what India has done. Like, saying that we are going to have a 5.1% fiscal deficit because the economy is doing well. The US has not done that. So they are having 8% plus fiscal deficit with 3.7% unemployment. So as the economy slows in the absence of continuous expansion in fiscal deficit, I think the debt to GDP can go up even more. The reason why this has not yet showed up in bond yields is that they've done something even worse, which is that 80% of their borrowing is being done on a short-term basis. So imagine the biggest borrower in the world borrowing short-term, and the kind of risks and vulnerabilities this exposes the financial system to. I think the US growth, maybe in another 6 months, 9 months, maybe they are able to forestall the problems till the next election, because it's in everyone's interest to keep it stable till the next election.
Absolutely.
But the medium-term outlook is very worrying. And if the US debt is unsustainable, it will mean that the 10-year bond yields remain very high. They are the risk-free rate for the world, which means that a lot of the financial assets that we look at will have to be sort of priced down.
Wow.
For China, I think again, using the labor, capital, and TFP model, labor input there is kind of flattish. So they're seeing a decline in the workforce, but their labor quality is improving, right? Because they're getting a lot more of college grads and all that. TFP growth, total factor productivity growth there, is negative. And this is, as you can imagine, as the control of labor and capital shifts from private hands to public hands, there is a very steep decline in productivity because the incentive structure is not aligned. In fact, that's another reason why India's TFP growth is so strong, is that the state is willingly taking a backseat. There are so many space startups in India, right?
Yeah.
Because now the Indian government has deregulated space.
Yeah, 100% FDI, in fact.
Yeah, so China, the TFP growth is a problem. And capital injection, where will you put it? So real estate is oversupplied, infrastructure is overbuilt. Currently, they are somehow trying to keep it going through investment in manufacturing capacity. And what is the scary thing for me is that, like in autos, their capex has gone up at 20% CAGR for 2 years. They currently have a manufacturing capacity of 50 million cars. Their domestic demand is 28. global demand is about 85. So they can do 60% of global car manufacturing sitting in China. They're doing the same thing for machinery, for batteries, for solar cells. Now, this is unsustainable. And so at some point, the capital formation has to slow down. A large part of capital formation there also used to happen through foreign direct investment. Now, FDI is the worst we have seen since they joined the WTO. And so I think China's medium-term outlook is very worrying for me. The only reason why for the world outside China, it is less of a concern, is slightly less of a concern, is that China being a net exporting country has generally, a lot of their imports are also to sort of generate the exports. So they're not a very big, or they're not allowed a lot of foreign firms or foreign countries to benefit from Chinese demand. So if Chinese demand does not grow very rapidly, other than say iron ore or some commodities, hard commodities, I suspect that the rest of the world will not be that badly affected. But what we need to worry about is China again exporting deflation and competitive threats for manufacturing companies globally from Chinese excess capacity seeping into their markets.
Okay. Coming back to India's story, you have mentioned in a couple of your other interviews and your writings or your kind of blogs about the India in 2053, which is about 30 plus years from now. Could you explain to us what's the rationale that you have, and you see that age 40 being the mean? Very interesting. Which everybody, when it's Mr. Mishra on the screen, he talks about. Could you explain to us, because you're really looking at it in a very different lens? If you could explain to us.
No, thank you. So, see, perhaps it's because how things changed for me when I turned 40. So, I'm perhaps influenced by that. But, statistically also, most countries' growth paths change dramatically when their median age crosses 40. And it is because, see, the country is just an aggregation of individuals, right? So if on average people are above 40, several things happen, right? The first is that your family is not growing anymore. Right? So and then your desire for a bigger house, desire for a bigger car, that expenditure does not happen. The second thing is that and remember that real estate is a very big driver of demand, right? So that is a big change. The second is your ability to work hard, your willingness to spend, right? Because as you start thinking about what happens when you retire, how much do you need to save, a lot of the things start to change. And therefore, it has been found that countries that cross 40 before turning rich never turn rich. And so a lot of Eastern Europe, increasingly, I would say Thailand and China, are, I think, headed down that path.
Okay.
And that, in a way, I think should set our expectations as we think about India. That when we have to think about how fast is good, right? That if you have to grow faster, is it good enough to be just faster than the world, or is there a growth path that we should set for ourselves, which we can sustain, and which will make us, rich before, as a country, we get old. Okay. And that is why I keep talking about the 2053, when the median age crosses 40. It is possible that, as we will say, 40 is the new 50, or 50 is the new 40, and 60 is the new 50, that you can keep working for longer. I think like Japan, right? The working age population is falling, but the per capita incomes are going up. The quality of life is still improving. So you can still get there, but you need to be at a certain level of wealth and income so that you can sustain that, right? So, for example, for Japan, what is remarkable is that they have so much of international assets, or even Taiwan, they have so much of international assets now because of sustained current account surpluses, that just the returns on those international assets are enough to feed the economy, right? So, for example, primary income, which is called, basically say, Japan has about $11 trillion of foreign assets, and about $6.5 trillion of foreign liabilities. So there's about $3.5 trillion, $4.5 trillion of, sorry, I'm getting it wrong, 7.5. So 7.5 trillion is the liability, 11 trillion is the asset, so 3.5 trillion is the net international investment position. The returns on that are so large that it accounts for nearly 4% of GDP. So their current account is still in surplus despite the aging population because they managed to get rich before they grew old.
Yeah.
And that makes them sustainable, right? So their quality of life is not deteriorating. And I think we need to aspire to get there, and which kind of sets us on a growth path that if we can sustain 7% for 30 years on real terms, and perhaps 9% in PPP terms, I think we can get there. But remember that if it is 7% over 30 years, it needs to be higher in the first 10, 15 years. Because as you start getting closer to the productivity frontier, your growth rates will start to slow.
Definitely. Coming to the Indian stock markets, are they overvalued? Do you feel so? Are they definitely expensive? But where do you see the Indian stock markets? Because they are eventually, like kind of a parameter of growth. You get to know if the markets are doing well, means something is really underway. But is that the real story? Your views?
Well, I think the good part about the market and the reason why some of this should sustain is that the underlying earnings growth is very strong. So even in the December quarter, which just ended, the EBIT growth for the BSE 200 was 20%.
Okay.
Which is a remarkable level of growth, right? So even after the COVID recovery and the low basis, we are still growing profits at 20%, which is fairly good. And what is also happening is that earnings revisions are no longer as negative as they used to be. So, for most of last decade, we were used to seeing regular earnings cuts. Suppose FY26 EPS, right? So every year's EPS lasts for about 30 months. It first is published in October of say 23, and so for 2.5 years, you keep getting revisions every 3 months.
Yeah,
they would be 1 to 3% cuts every quarter, and one EPS integer for the Nifty could fall from 10% to 30%. So suppose it started at 100, it would end at 90 or 70, or somewhere between 90 and 70. In the last 3 years, we are seeing upgrades. So it starts at 100, but it ends up at 102, 103, 104. And this is remarkable. And that is also very supportive of the market, right? Because what happens every 6 months or 3 months is that you gain 3 months of the next year.
Yeah.
Right. So when you say roll forward EPS, so if today, I'm on say in February or March, I'm looking at FY25. 3 months later, I'll be looking at 9 months of FY25, 3 months of FY26. So you're gaining forward, and because cuts are not happening, you are gaining 3-4%. So that's very supportive. Where I'm uncomfortable with the market is the price to earnings multiple, right? And so this is where you have a problem of too much too soon. So, and this is how markets behave. They never move in a straight line, right? So you can have a very decent medium-term outlook, but if the market just goes up too fast, then there has to be a period of sort of digestion, what I would call time correction. Given what we just discussed about US 10-year yields, which, whether we like it or not, set the cost of capital for the rest of the world, my apprehension is that the PE multiples that we have become used to during this period of easy monetary policy in the US are not going to sustain over the next 10 years. And perhaps we will not go back to 13, 14 times, which was a norm in 2012, 13, 14. Perhaps we will only go back to some 16, 17 times. Because India's medium-term trajectory is better. Markets are much more domestically driven, so much more predictable. I mean, earlier FIIs would drive a lot of volatility. So stability also gives a higher multiple. Currency is much more stable, so the country risk premium is a lot lower. The government and the RBI are prioritizing stability over growth, which also warrants a higher multiple. So I hear all of that, but at the same time, it's an open market, and meaning freely ownable by foreigners, and therefore if the global price to earnings multiples, because of weaker global growth, because of higher cost of capital, it starts to come down, I think Indian PE multiples need to be lower as well. And that's what keeps me a bit worried about the current levels. But if on a 3-5 year perspective, I think markets should still deliver decent returns.
In fact, when it comes to money coming into India, be it FDI or otherwise, in fact, I have my neighbor who's a Chinese neighbor asking me last weekend, hey, I want to invest in India. How do I go about with that? That's the kind of euphoria that's India, because last 7 years they have been our neighbors. They never spoke about India, and investment is the last thing. My question to you is, the money that is coming into India, and more so the JP Morgan, the bond money, do you think India can manage the kind of money coming in? Are we ready for it?
And the first, I think, your neighbor will have to be very rich to actually move the needle on capital flows into India. So let's look at bond flows and equity flows on the portfolio side, and then look at FDI, right? So see, bond inflows, because of index inclusion, are going to be maybe $20 billion. 25 maybe, but a lot of that has already come in. So, and some of them are front loading in anticipation of index inclusion. And when that comes in, it's a one-off flow, right? So suppose, there's 213, 217, the last I saw, maybe slightly lower now, of assets under management, which is benchmarked to the JP Morgan Emerging Markets Index. Given what's the prevailing view on emerging markets, especially because of China exposure, it's quite possible that the AUM, assets under management, in benchmark to the JP Morgan index may be lower by the time India gets included, right? And unless that is growing very rapidly, suppose it stays unchanged at $220 billion, right? Then there will be a one-time flow, 10% of that will come to India over 10 months. That's it, right? What next? So then the more flows will not happen. There will be a new a type of investor active in the Indian market, which is a good thing. But beyond that, why will there be any flows? Secondly, on the portfolio flows into Indian equities, while it'd be great to have a much more diversified set of buyers from the foreign side. Remember that a very large part of foreign portfolio flows into India come from emerging market funds, Asia funds, BRICS funds. All of them have India or have China. So when I talk to EM fund managers or Asia fund managers, and they are very worried that despite significant outperformance because of India overweights, they are still losing assets. They are still losing funds because the China exposure, and people don't want to be exposed to China, and China is still losing money. So, or their exposure in China is still losing money. So I think the portfolio flows into equities will not be as robust as some people think. And frankly, even on the FDI side, a very large part of FDI was, in the last 4-5 years, VC, venture capital, and private equity money. And so that itself is going through some digestion. In fact, whereas, in 2019, one could have painted a story that aggregate capital flows will be $75-80 billion a year. Today, given the high cost of capital globally, it is debatable whether India can get more than $45-50 billion in a year. So I don't think this situation of having too much money to manage or a gush of capital, which is hard to manage. Remember that in 2007-8, we got $107 billion. Right? And it was a much, much smaller economy.
Absolutely.
So if there is an excess, there are tools and mechanisms which I think regulators know in India, which will be able to manage. As of now, I see the problem as a reverse, that capital flows actually in aggregate would still be a problem, despite India being the darling of most investors.
Okay. I wanted your views on the employment scene in India, because when we talk of jobs, right, they're more of in the services sector, the urban, the Bangalore's and the Mumbai's and the Hyderabad's of the world. What about the rural scenario? And I'm sure you've been an economist, also have been on the ground, actually visiting these places. I wanted you to share what's the kind of Bharat that you see, what you've seen ages back and now. I'm sure there is significant improvement, right?
Yeah. So that is where the biggest change is, right? So, there are changes in Bombay and Delhi as well, but there's a big change in the rural India, right? So, these days when you travel, you rarely, I mean, I've not seen a thatched hut with mud walls for a while. And rural areas now have 20 hours plus of electricity. Almost every village is connected with an all-weather road. There are pipe water connections, toilets, two-wheelers, meaning motorcycles, TV connections, smartphones. So the boundary line between, in fact, one of the urban consultants in urbanization was calculating that if you drew a circle of 60 kilometers radius around most urban townships in India, which is 1 hour on a motorcycle, it would be 70% of India's population.
Wow.
So the urban-rural divide is actually a lot lower than what it used to be. A lot of urbanization in India is what I call in situ urbanization, in the sense that it isn't people moving to a city, which is the way it happened in China. It is actually villages growing into a cohesive thing, and then collectively moving out of agriculture, which is the definitional thing for urbanization. So changes are happening. When you think about jobs, it's a mistake to think that all the jobs are in urban areas. In fact, even by the geography of, say, factory investment, even back in 2012, 75% of incremental capex on manufacturing happened in rural areas. Because as you can imagine, that land in the city is very expensive. So if you want to acquire 100 acres, 200 acres, generally be in rural areas. And wherever you have that, and a lot of local people come and start working. But that is still a small part of the job, right? So when you see massive job creation, it is actually in construction. So if the real estate cycle is turning, there will be jobs all through. And the good thing about construction and real estate is that it's naturally widespread, it's very broad-based. So unlike national highway, which, like if you're building the Delhi-Mumbai national highway, so there's a straight line along which jobs will come. In real estate, I mean, they're all over the place, right? So that's very important. There's a lot of services jobs. So new shops need to be opened, new healthcare startups, meaning diagnostic labs, nursing homes, hospitals. There's a lot of jobs for entertainment. If you look at, as leisure picks up, meaning people have like what I call commercialized leisure, right? So instead of working under 20 hours a week, if you're working, say, 60 hours a week, and you have some income, you want to watch a movie, you want to watch a play, you want to go out to a sports stadium. And so I think lots of different types of jobs will come up. I think it is a mistake to think, and think about even the remarkable growth in services exports from India, right? What I would call non-IT services export. We discussed earlier, chip design, running a semiconductor fab from India, processing oil drilling data from all over the world. 70%, or rather say 40-45% of global consulting jobs are in India. Now, if you have a large number of people who are earning 2.5 million rupees a year, they will need to spend there, right? So they will need a bigger house. They will want to get their kids more coaching for tennis and for chess and for swimming, and this and that. All of this is happening. And you will be spending a lot more on entertainment. One of the reasons why Sri Lanka and Thailand are benefiting and they've given visa on arrival for Indians is that all Indian hotels are too expensive now. Right? It's much cheaper to travel to Thailand and Sri Lanka than to travel within India, which is quite remarkable. And I would say a sad state of affairs. We need to expand hotel capacity.
Exactly.
So, so these are things that happen, and these create a lot of jobs.
Yeah, absolutely. You have been a part of the Prime Minister's Economic Advisory Council. How has been the interaction generally with the Prime Minister, and as a part of the Advisory Council, any sharing in general? Of course.
Oh, it's a very very keen listener. So it is remarkable with how long he can concentrate and for very long meetings, pay a lot of attention, and on a very wide range of issues ask probing questions. And a very deep and innate sense of what is right for the economy and what is not. So the economic instincts are, I think, very finely tuned. For example, that lower tax rates will get you more taxes, right? This is something I've heard you say several times. So it's been quite a privilege and definitely very, very, I would say, it's almost a learning experience, right? So to see how you take ideas in, you frame policies, and then you get them implemented, and that's been very enriching as an experience.
Great. Mr. Mishra, you say that you're not an economist. I mean, as if you're not studied economics. You're coming from IIT Kharagpur and Kanpur, and then you moved on to Hindustan Lever, and then on to banking, also in Infosys, right, for a short time. Your world, you have delved into different industries in a way. And how come an economist, end of the day? If you could just walk us through your journey quickly.
So kind of a self-taught economist, which is why it took much longer than if I'd done a course. So when I moved to Credit Suisse First Boston in 2003, it was from Infosys. It was to help cover IT services, but then I was in Singapore because CSFB was not in India at that time, and I started helping my boss on hardware tech and semiconductors. He was the tech strategist. So I loved going to Taiwan, attending meetings with the whole diverse tech chain, very enriching. And then when he moved out and I had to become lead analyst, I went to Taiwan. I got married to an Indian doctor. She couldn't work in Taiwan. And thankfully we were restarting our India business. So I raised my hand that, look, I need to move back. There was no hardware tech at that time. Thankfully, one of the reasons why I'm part of the ISM is because of my experience 20 years back on tracking the tech supply chain. And when I moved back to India, again, I became a healthcare analyst and then a metals analyst. And so when the India strategist left in 2010, the firm asked me if I wanted to become an India strategist. And I said, okay, I have zero training in economics. And frankly, I didn't understand any amount of macro at that time, or not much of macro at that time. I've always been an avid reader, so I knew I could do it, but I didn't know it. So the firm took a chance. I'm very grateful they did. And then I kind of asked myself the questions. And so first I figured I was looking at what was happening to inflation and why is it not falling down. And read a lot of papers, asked a lot of smart people, and figured inflation was not going to fall down.
Okay.
And I was proven right. And I said, oh, this works. Then I looked at the currency and I found the currency moves so fast, but no one knew about it. So can I predict it? And I tried predicting it and I saw, oh, I can do this as well. And so one thing led to another. I kind of then started digging deeper into the informal economy. When I did this, this impact of rural roads, like we called it the silent transformation of India.
Mm-hmm. Yeah.
The rural roads, how it led to electricity, it led to phones, and how it was transforming India. And then people said, oh, why isn't this showing up in GDP? So then I said, oh, so how do they calculate GDP? And then I taught myself how they calculate GDP. Then figured that 40% of India, 45% of India's economy is informal. It cannot be measured, can be estimated. So they'd work on the informal economy. So as I did one thing after another, trade theory, this, that. So over a period of time, I seem to have, taught myself a bit about everything else. So I still am not a trained economist, but
a practical economist. But you're a practical economist.
Well, you're being very kind. I wish I had done formal training, but I kind of have a decent sense of the big moving parts and what can drive future growth. So quite grateful I got the opportunities.
Wonderful, wonderful. Last one before I let you go. You appear on business television, you appear on a lot of podcasts where you're a senior economist. You talk about the economy, you talk about the global indices, etc., etc. What's in a day of Mr. Mishra on it when you unwind? What are your interests otherwise beyond reading? And I'm sure serious reading.
Yeah, so reading is, going for a long walk with a good audible book is what I find most relaxing. But my biggest fun time is spending time with my kids. Doing some Python programming. I don't know if it is fun for them as well. I'm hoping it is, because they seem to be happy doing it. But or learning math or solving math problems. And I don't socialize much, so basically most weekends the four of us will be watching a good movie on TV, and we like to travel. So nature, history, and what I absolutely adore is that my kids are also at least the apple is not falling far from the tree, in the sense that we could take them for a week in London and spend all our time in museums.
Wonderful.
And they didn't complain. So they actually had quite a bit of fun. So yeah, so I like doing that.
Wonderful. Mr. Neelkanth Mishra, thank you so much for joining on my podcast, The Sound of Money.
Thank you, Santosh. It was a pleasure talking to you. Thank you.
And well, with that, we come to the end of this edition of my podcast, The Sound of Money, with me, Santosh Sirur, and Mr. Neelkanth Mishra. Thank you once again for joining us. Bye-bye and take care.